Welcome to The Explainer. Today, we're unpacking a really fascinating story right at the heart of the global energy transition. We're looking at Plug Power's Q1 2026 earnings report. You know, for a company operating right at the center of the hydrogen economy, the stakes have been, well, incredibly high lately. But as we dig into these numbers, a really compelling narrative starts to emerge. We're talking disciplined execution, totally surprising financial beats, and a genuine strategic shift toward actual profitability.
Because let me tell you, Wall Street was absolutely not expecting this from Plug Power. The hydrogen company just reported 22% revenue growth and huge improvements in margins, sending investors into excitement again. For a while there, the market had been highly skeptical about the timeline for hydrogen profitability. But this quarter, man, it threw a massive wrench into that skepticism.
So the central question we really need to investigate today is this. Could this be the beginning of a massive comeback for Plug stock? Are we just seeing a temporary blip, or is this the actual structural turnaround of a green energy giant? Well, we're going to use the data straight from their earnings release and executive call to find out.
Section 1. Fueling massive revenue growth.
Okay, before you can optimize a business, you got to actually prove people want what you're selling, right? And the headline figure proves exactly that. $163.5 million in revenue for the first quarter of 2026. Now, what you should take away from this isn't just the sheer size of the number, it's the context. The company explicitly noted that this figure actually exceeded their own internal expectations. You know, when a company beats its internal targets, it heavily points to accelerating demand.
Just look at the comparison. Going from Q1 2025's $133.6 million up to Q1 2026's $163.5 million reveals a super healthy 22% year-over-year revenue bump. And here's the kicker. This wasn't just isolated to one lucky contract. Management noted this growth was actually driven by broad demand across their core markets.
Let's break down exactly where that growth is coming from. First off, electrolyzer revenue literally skyrocketed. It went from $9.2 million up to $40.8 million. I mean, that is a massive scale-up as their large-scale projects finally move through commissioning. We also see hydrogen fuel sales increasing by 22%, and that's driven by customer growth and rising prices. Even their legacy material handling platform grew 15%. So they're pretty much firing on all cylinders across the entire platform right now.
Now, to really understand that massive electrolyzer revenue jump, you've got to look at the tangible reality on the ground. Plug Power isn't just out there selling concepts. They are building major global infrastructure. We're talking about executing on a 100-megawatt system with Gulp Energia over in Portugal and a 25-megawatt system with Iberdrola and BP in Spain. Plus, they just secured a massive 275-megawatt early-stage engineering or FEED award with Hy2gen up in Canada. This is real steel in the ground, and it's translating directly into that top-line revenue growth.
Section 2. The Gross Margin Miracle.
Now, revenue is only vanity if you can't actually keep it, right? But look at the sheer velocity of this turnaround. In just one single quarter-over-quarter comparison, GAAP gross margin improved from a painful negative 55% all the way to negative 13%. Okay, yes, it's still negative, but this represents a 71% overall improvement and a staggering 42 percentage point jump in the margin rate year over year. That's not just a tweak, that is a structural shift in their business model.
So how exactly did they pull this off? The crucial point to remember is that this wasn't an accident. It was driven by an internal initiative called Project Quantum Leap. I know, it sounds a bit like a 90s sci-fi show, but it actually worked. It yielded a 30% reduction in GenDrive per unit service costs, largely because the equipment is just getting more reliable. They also secured lower third-party sourcing costs. And incredibly, the hydrogen fuel margin rate improved by 54 percentage points all by itself. That was driven by greater volume, which gave them much better leverage over their fixed overhead costs. Which leads us perfectly to this quote from Paul Middleton, Plug Power's chief financial officer. He stated plainly to Wall Street, "The year-over-year progress reinforces our belief that we've hit an inflection point." And listen, when a CFO uses the phrase inflection point, they are signaling loud and clear that the structural bleeding is stopped and operational leverage is finally kicking in.
Section 3. Improving the bottom line. So margin improvements are fantastic, but how does that actually impact the real earnings? Well, for adjusted earnings per share, they beat expectations. Back in Q1 2025, they sat at a loss of 17 cents per share. Fast forward to Q1 2026, and they cut that loss almost in half, down to just 8 cents per share. By removing all the one-time and non-cash noise, this adjusted metric proves that the operational progress we just looked at in the gross margins is flowing directly down to the bottom line.
Now here's a quick insider secret for you focused learners out there. If you look at the raw unadjusted GAAP EPS, it was actually negative 18 cents. So why the big difference? Well, this comes down to an accounting quirk. That wider gap includes roughly $140 million in non-cash charges. And surprisingly, this was heavily driven by adjustments to convertible debt and warrant valuations, simply because Plug Power's stock price went up. Yeah, it's essentially a non-cash paper penalty for having a rising stock price. And that is exactly why we focus on the adjusted 8-cent loss, to see the actual, real business performance.
But of course, the absolute lifeblood of any corporate turnaround is cash. You need runway to reach profitability. And Plug Power ended the quarter with a massive $802 million in total cash. To break that down, it's split between $223 million in unrestricted cash and roughly $579 million in restricted cash.
To fund operations through 2026 without running dry, management actually laid out a very clear timeline. They expect the release of about $50 million per quarter from that restricted cash pool. On top of that, they anticipate about $275 million from an asset monetization linked to Stream data centers, with $142 million of that expected to close as early as June. Plus, they expect another $39.2 million from selling an investment tax credit in Louisiana by the end of May. So this multi-pronged approach is entirely aimed at ensuring their financial sustainability.
Section 4. A massive comeback at hat.
So, the big question, can they sustain this momentum long term? Well, CEO Jose Luis Crespo provided a very explicit roadmap for 2026. The company is projecting a full-year revenue increase of 13 to 15%. They expect sequential margin improvements, meaning, every quarter should look a little bit better than the last. But the real crown jewel here is their target, achieving a positive EBITDA run rate by the fourth quarter of 2026. Put simply, in plain English, that's the exact moment they aim to flip from burning core operational cash to actually generating it.
And what gives them the confidence to hit that Q4 target? Well, a massive catalyst cycle is approaching. Major deployments and large fleet refreshes with top-tier clients like Amazon and Walmart are projected for late 2026. On top of that, the recent reinstatement of the investment tax credit is actively boosting the economic attractiveness of their solutions for these massive industrial customers. It's a real game changer for demand. Which leaves us with this final thought to ponder. We've seen the 22% growth, we've seen the 71% margin improvement, and we've seen the strategic cash management. But the ultimate test remains. Is this true inflection point enough to convert all of this massive global scale into sustained profitability by late 2026? The trajectory is suddenly looking incredibly strong, but execution in the coming quarters will be absolutely everything. Keep your eyes on that Q4 EBITDA target. Thanks so much for joining me on this explainer, and keep learning.